Thanks for joining us today on Market Call. I'm Marella Fernandez. Mike Philbrick on the show, CEO at Resolve Asset Management. He'll take your questions on exchange-traded funds. Here's how to reach us. Call us toll-free at 1-855-326-6266. You can also send an email to marketcall@bnnbloomberg.ca. Mike, thanks for joining us today.
Hi, Marella. Thanks for having me.
So mixed markets so far in North America on the day, but overall, a lot of strength, new record highs being reached almost every week. How much of this would you say is the evolving AI story?
Well, I think a lot of it is that. I mean, the first phase of AI rewarded those semiconductor and software stocks, and you're seeing that today in stocks like Micron and the chip sector up substantially. But I think the next phase may be increasingly rewarding the electricity, infrastructure, and real assets side of the economy. Yes, this CapEx spend that is occurring is broad, and it's got many support from many governments across the world. And so, yes, it is driving a huge capital spending scenario that is driving markets higher in a lot of cases.
So you see some broader participation moving forward?
Yeah, I mean, AI is now colliding with the physical economy. It's not just software anymore. AI cannot run on enthusiasm alone. You need electricity for those data centers, the transformers, cooling. You need copper. You need transmission infrastructure. So I see it broadening out into the physical economy. You've got this S curve of technology adoption, which is, has very small limits to adoption to it. But it meets the J curve of resource production that, you've got to make investments in mines and places and plants and refining in order to have the physical infrastructure to build out to provide the electricity for the inference that is created by the AI wave that's coming. And this probably means structurally stickier inflation. Unlike software booms, the build out doesn't consume a lot of real world input, but this does. Energy, labor, materials, infrastructure, all are coming to a point where we need a lot more of that to meet the demand for the inference coming from AI. This should also cause the broadening of the market leadership as well, mid caps, cyclicals, industrials, utilities, things like that.
Without giving away your top picks for the end of the show, I'm wondering if there is what your focus is. Is there a sector amongst what you just listed that you prefer to focus on?
Well, yeah, I think investors want to make sure that they have some exposure to those areas that we're talking about that are a little bit more physical. In Canada, our index tends to skew that way, right? So we've got lots of rocks and trees and oil and gas in Canada that build our economy. In the U.S., that index, the S&P 500 or large cap U.S. stocks, is dominated by technology stocks. Most people don't know that in 2008, the largest stock in the S&P 500 was Exxon. Today, oil and gas, energy, represents about 4% of the S&P 500 index. So there's a blind spot there for that index. And it's not to say, go make a commodity bet. It's to say that you've got this big growth engine out of the U.S.'s technology. It's very complemented by Canada's resource infrastructure and other things like commodities and utilities and things like that, precious metals to a lesser extent.
All right, let's leave it there for now. We want to get to phone calls and emails when we come back. For Mike Philbrick of Resolve Asset Management. Again, he's taking your questions today on exchange-traded funds. Here's how to reach us. Back in a moment. Welcome back. Mike Philbrick joining us today as our guest. We're going to start with an email from Ash. Ash writes in, please provide your opinion of iShares Global Gold ETF. So it's XGD on the TSX. This one mimics the S&P for capital growth. Do you know it pretty well, Mike?
Sorry, XGD?
XGD is what I have.
Yeah, that's the iShares Gold ETF.
Gold, yes, the Global Gold. I have it as an exchange. Yeah. It's a Canadian fund that does long-term capital growth is what I have.
Correct. Correct. And so this invests in gold equities, and I think those remain quite supported, although volatility is likely to stay a little bit more elevated. It's interesting that in the options market at the moment, puts are far more expensive than calls, meaning there's a great desire to hedge downside generally. That is counterintuitive. To me, that says there's probably a little bit more upside that might be unexpected. But these gold miners are going to benefit from the strong price in bullion that we've had, improving cash flows, and continued investor interest. And I think, we're a long way from having rate hikes as a sure thing. And as that comes about, gold potentially has the opportunity to rise. So I think as a diversified exposure to large cap global gold mining companies, this is a very good one. You can get a little bit of exposure just to the majors in this one. So another option is ZGD. This is the equal weight portfolio of gold companies from BMO. So that's something that might be a nice complement to this, or something that goes along with this. I would say, one has to still remember that gold equities are still equities, and they can experience pullbacks as we've seen. But I think we're in a period now where we should be looking back into the precious metals areas and starting to accumulate those positions. We've talked about it in previous shows over the last couple of years. We had that big spike recently. That's cooled off, but that's a good thing. We're digesting those gains, and I think that gold remains quite supported over the long term.
Okay, let's go to the phone lines. And Ray's on the line. He's in Pickering, Ontario today. Ray, go ahead.
Yeah, hi, Marilla. Yeah, Mike, I'm a traditional stock picker over the years with my portfolios, but I just, with the energy crisis going on and, the financials with the Canadian banks going well, I just think the TSX is going to have a positive growth spurt here, maybe in the next 2-3 years. So I'm looking at just buying the TSX as an index fund, and I was looking at VCN. If you could comment on my strategy here, and if you think it's a positive outlook for the market. Thanks.
Okay, thank you. Is there something that you look at that for the TSX next 2 to 3 years that you like?
For me, I think the caller and VCN provides really broad exposure to the Canadian equity market. So this is across large, mid, and small cap companies. That's why I really like this one. And this will dovetail into some of our top picks today. So it's a low-cost way in one single ETF to get a heavy exposure to financials, energies, materials, and industrials. And I think the caller is bang on that Canada stands to benefit from what we're talking about in the next wave in the AI boom. If you look at the next bottleneck, it's power. And what do you need to create power? Well, you need the energy, you need the materials, you need the industrials to build the power plants, you need the energy to facilitate that movement into electricity. And I think he's bang on. Canada could benefit quite substantially in market leadership over those mega cap technology stocks. And we've already seen that. Canada has been outperforming the US. If we look at the drawdown we had earlier in the year, and you look at the Canadian market, if you're looking at VCN now, you can see that drawdown was less. So again, Canada remains somewhat concentrated, banks and energy and those types of things. At the same time, the natural resource side of that equation should do quite well. And I think it's a great complement. And I really like VCN versus something like XIU, which is just the large caps. VCN has large, mid, and small cap stocks. So I agree with the viewer. I think this is a nice position for a portfolio for a Canadian.
Okay, let's go to the next caller then. Audie is on the line in Waterloo, Ontario. Audie, go ahead.
Yeah, hi, Marilla. Hi, Mike. I bought HOD. It's an inverse oil ETF, and it's doing really well right now based on the fact that oil has dropped. Do you have an outlook for about 6 months on this ETF if oil continues to drop?
Okay, thank you for the question, HOD. So that's the Beta Pro crude oil inverse, as you mentioned. So a bear ETF. Right. What do you think of it for the next couple of months?
It also has 2 times leverage on the downside. We shouldn't forget that. So when you're buying a leveraged ETF like this, one thing you have to remember is that it is more of a trading vehicle rather than a long-term hold. Because of the enhanced volatility, what you can get is what's called volatility drag. You can also get the enhancement on the way up as it goes up because it compounds the gains every single day. The challenge there is, when you have a 10% loss, it requires an 11% gain to get back to even. So it's one of the things just to be careful of any kind of levered ETF that you're using. Now, on the crude oil side, we're at an interesting point. We have news that in the Strait of Hormuz that things are being worked out and that oil supply could restart. And what's interesting to me is you had this strait blocked. 20% of the oil that can flow to the world is blocked, and yet we couldn't get oil to $150. It says to me that there seems to be an awful lot of oil sloshing around the system. I don't know how else that could happen and not have a bigger price response. So if we get reopening of the strait, then you could see oil normalize back down substantially lower. But again, this is a geopolitical bet on what might happen in political negotiations, which is very hard to take a position on. But if you're firm, you've got a good view on it. That's going to give you upside potential as oil comes back in price, if it comes back in price with the opening of the strait and the calming of those geopolitical tensions that are ongoing. I kind of think that's the case more than not. But at the same time, we need a lot of energy to build out all the inference. So there is going to be a bit of a bid, and then we're going to be looking at, well, what are the producers doing? Are they maintaining any kind of vigilance in their production, or are they just going to produce all out? So it's a tricky question. If you think oil's going lower, that's a way to play it. Maybe you want to rebalance it a little bit here and there when you get some big profits so that you don't end up giving it all back.
Let's leave it there. We will take a quick break. Mike Philbrick, Resolve Asset Management, taking your questions on exchange-traded funds. Again, here's how to reach us. Back in a moment. Welcome back. We have Mike Philbrick with us today to answer your questions. Let's go to an email from Jerry. Your opinion on BMAX is what he asked. Can you tell me a bit more about BMAX today?
Sure. BMAX is the Brompton Enhanced Multi-Asset Income ETF. Now, this is designed to actively manage an income-oriented portfolio that combines multiple asset classes. So things like equities, fixed income, there's some covered call writing strategies in there, and some alternative income-generating exposure. And so the goal is to provide a little bit higher of a monthly income while remaining a diversified exposure across global markets. And so I think it's a reasonably good proxy for that. And having multi-asset strategies in your portfolio, I think today is pretty good because you've got a mix of inflation, interest rate shocks, different market leadership. So that helps smooth the portfolio volatility while you do that. The trade-off, as always, when you're enhancing income strategies with covered writing, is that you're capping that upside exposure. So if you were to compare this to something like an XGROW or a VGROW, which are similar multi-asset ETFs, maybe a little bit more simple in their diversification, what you see is an underperformance of a couple of percent over the last year. And so that's what you give up for writing those calls in a bull market. Remember that call writing works in a slightly down, sideways, or slightly up market. That's when it works the best. So when you're in a strong bull market, you are going to give up some of those upside opportunities on a continual basis because you're selling those calls and capping your upside in order to get that income. So just some things to consider there. But overall, yeah, it's not a bad play if you're willing to make that trade-off between the income and the size of and the potential growth capture.
Let's go back to the phone lines. And Mike, Elliot's on the line in Hamilton, Ontario. Elliot, go ahead.
Good afternoon. Please, to get a grandchild started, in Canadian dollars, we're looking for an ETF that gives broad exposure to the entire U.S. economy, equities, bonds, alternatives, et cetera, and hopefully one that isn't just 50% the Mag 7 and AI. Does such a beast exist? Thank you.
Thank you for the question. Mike, go ahead.
Okay, that's the multi-asset part is an interesting one. Let's take a look at that. So if we look at that from the perspective of Fidelity has an all-in-one balanced ETF, FBAL. And FBAL is nice.
FBAL?
FBAL,
Thank
yes. And so, so that gives you. They also have the Fidelity All-in-One Equity ETF, but the caller did ask for something that was a little bit more balanced. Now, this isn't U.S., so this is more globally diversified, and that's a way that we can get away from just having the Mag 7. The challenge is if you look at anything market cap weighted in the U.S., it's going to be it's going to have that huge exposure to the Mag 7. So what I might suggest is let's look at a globally diversified portfolio. It's approximately a 60-40 mix. So you've got some bonds in the portfolio to help with the downside protection, and it expands beyond that handful of mega cap growth names. And so it's really good in that you get automatic diversification. The rebalancing happens on your behalf. And there's also in all of these all-in-one products, there's little things, diversifiers, 1 or 2% in Bitcoin and things like that. So it's a nice diversified portfolio. Go global to get that other part and de-emphasize the U.S. That's how I would approach it.
Okay, but if you are happy with the tech weighting, you could go with just the U.S. market, is what you're saying.
Yeah, you can. You can look at something like. You certainly could. Okay. The caller did mention that he wanted to de-emphasize that side of the equation. One of the ways to de-emphasize it is including sort of those global stocks. Remember that now the U.S. economy is 70%, 65 to 70% of the global market.
Okay.
So I think it's, you're diversifying a little bit. Only sort of 35% of the portfolio gets outside of those U.S. stocks. So you still got that growth engine underlying in the FPAL portfolio.
Let's move on then to the next caller. John's on the line in Markham, Ontario. John, go ahead.
Good afternoon to both of you. Thanks for taking my call. Mike, I'm retired. I'm using a lot of cash through money market funds in my retirement account. And that was fine a year ago when it was at 4%. Now they're at 2.4%. I'm looking at a put writing / covered call, but more emphasis on put writing that is not tied to equities per se, that can give me a relatively safe, 3.5 to compete with a money market fund that doesn't have NAV erosion. I know it's a bit of a tall task, but I was wondering if you have anything to suggest.
Okay.
Thanks.
Thank you for the question. It's very specific what he is looking for. Does that exist?
Here's the challenge. That if you're comparing it to a money market fund, that's going to be a bit of a challenging situation because a money market fund, although the yield is lower, it's also quite certain. So we are stepping out the risk curve. And there are various options out there, and we can go through a few of them. We've got things like some put writing strategies, put and call write strategies, and just it's the area. So SPAY is the Global X U.S. Treasury Premium Yield ETF. So you're getting about 7% there or so. But again, you're writing puts and calls on treasury bonds, not equities, but they can have some volatility as well. So if we are in an environment where inflation is stickier and we do get rates rising, that's not going to help bonds. So that's the challenge you have. You have a risk there. You are doing covered writes on U.S. treasuries. That might be a little bit helpful. I think... so there's a number of those. H-Bill from Hamilton U.S. T-Bill Yield Maximizer ETF. That's another one. But again, there's some risks there. So there isn't really a free lunch so much. So I would watch it carefully. And, that's one of those tough ones. And then if you get in the equity market, then you've got equity market risk when you're writing puts and calls. And they do capture the downside. So that's in a slightly falling market, you'd be okay in those scenarios. But if you get a true market correction, you'll see NAV erosion.
Let's take a quick break. We're going to come back with past picks from Mike when we return. Stay tuned. Welcome back. Time to go through Mike's past picks from August 29th of last year. Mike, at that time, you chose iShares as silver bullion ETF, so SVR on the TSX. It was $18.94, now to $34.40, 82% upside, 82% for total return. Is that basically on the rising price of silver, and is this something you still hold?
Yes, it is on the rising price of silver. So the iShares Silver Bullion ETF holds silver bullion explicitly, so it should track that asset. And the interesting thing about where silver fits in the current environment is it benefits from both industrial demand as well as real asset scarcity. So with the ongoing AI and electrification build out, materials like silver remain in high demand for power systems, electronics, solar infrastructure, and so on. And at the same time, silver also continues to act as a monetary metal during the persistent fiscal deficits and inflation uncertainty. So yes, still holding, would recommend that people continue to have a position in silver. Again, this was one of those higher volatility assets. So position sizing is crucial. Maybe have a smaller position size so the volatility doesn't overwhelm your portfolio. And secondly, when we had the huge run, rebalance. Take some off the table, look around, look to rebalance into other things in your portfolio. And when we have drawdowns like this, if you were supposed to have a 5% position, it's now 4%, you'd be re-upping back to that 5%.
Okay, let's get to your next past pick, which was the 3IQ Solana staking ETF. SOLQ on the TSX. Last August, it was $22.90. It's down to $9.28, so 58% drop for return and total return. Is this a cryptocurrency ETF?
Yes. So the 3IQ Solana staking ETF holds and stakes the Solana blockchain. So this is on the digital asset side, and this is the long-term adoption story around blockchain infrastructure. And that has actually strengthened. Now, while the price has declined, and again, this falls into the same camp as the silver ETF, this is going to be a highly volatile asset. So have a little and rebalance. And as we're having the drawdown, probably be rebalancing your portfolio into that small exposure, because as we get agentic AI, this is AI that does things on its own, it's going to be quite constructive for digital assets like Solana, as you know, we have it being one of the active blockchains in the ecosystem tied to payments, tokenization, decentralized applications, and allowing staking. So this ETF allows staking, which gives you a bit of a yield. So this is something I would keep on the radar. If you bought it back then and it's become a smaller position, maybe think about rebalancing up a little bit. I think as we come into the end of the year and into 2027, this whole field is going to benefit from agentic AI, because that is how transactions will be processed and paid for.
Let's get to your third past pick then from August last year. iShares, the U.S. Small Cap Index ETF, so XSU, which is on the TSX, 44.84 at the time to 54.49 today. So 22% upside, a 22% total return. Can you give me an idea of, are there specific small caps in this? Is this a range of small caps? What's in this?
No, this is the broad small cap, U.S. small cap index. And so it remains interesting because market leadership continues to broaden. If we look at over the last year, you see those small caps outperforming the S&P 500, and that continues to be the case. So a year, if we looked at XSP on Toronto, which is the S&P 500 in Canadian dollars, it's up about 25%. The XSU over the last year is up about 37%. That's 12% outperformance thus far. And this gets us away from those mega cap stocks. This gets us into those smaller companies that are feeling the benefit of AI enhancements. And so we're seeing that improving cyclical breadth as we see smaller companies participate in the domestic economy. So as long as the economy avoids a hard landing and capital spending continues to expand, small caps should still have a position in your portfolio and likely will continue to outperform.
All right, let's take a quick break, Mike. We're going to be back with phone calls and emails from Mike Philbrick when we return. Stay tuned. Welcome back to Market Call. Dave's on the line. He is in BC with his question. Dave, go ahead.
Yeah, thank you, Marilla. Mike. I have a bank, it's called Bank. It's a Canadian banks on life goals, and it's doing quite well. But it's around stays just under $11. I was thinking adding more, but I was wondering if it'd be a good idea to add some more at this price, seeing how it doesn't seem to get past $11.
Sorry, can you give me the name of it again?
Bank, B-A-N-K.
B-A-N-K. Okay, thank you. Mike, do you know this one? Is this something you'd put more money into?
It's the Evolve Canadian Bank and Lifeco's Enhanced Yield Index ETF. Financials have been doing well, Canadian banks particularly well. You've got the enhanced income on this. You've mixed in the Lifecos. It is in a very strong trend. So the trend is your friend, and I think you can add to it. I wouldn't be doubling or tripling my position, but if you've got exposure, depending on what your total exposure is in your portfolio, how much you might want to get invested in this, those are all questions you have to ask yourself. But in a strong trend like this, I would say yes, you can add to that portfolio. And there's a number of those different portfolios that focus on banks and financial services, but bank is a fine alternative if you're looking for that exposure simply in the banks and the Lifecos.
We've had some of the Canadian banks start to report, as I'm sure you know, Mike, and they're doing pretty well. But do you have any credit concerns moving forward?
Yeah, I mean the Canadian banks are a mix of real estate exposure, natural resource exposure, and so at the moment the natural resource and business growth side of it seems to be overwhelming any of the concerns about the potential loan loss provisions around mortgages and things like that. And that's what it'll be. It'll be a mixed bag, but at the same time, we do have to respect price, and price is pretty strong, telling you that the market feels that growth is more likely than the negative consequences around what may be coming from credit concerns.
Let's move on to the next caller. Then Mike is on the line. He's in St. John, New Brunswick. Mike, go ahead.
Oh, hi, Marilla. Hi, Mike. Just a little dilemma. I've got a large GIC that's in my TFSA, so it's coming due, and I'm just wondering, I was going to transfer it direct into XEQT, and it's going to be a long-term hold for 5 or 10 years, and its strategy is just generational wealth building. I just wondered what your thoughts on that ETF are. Thank you.
Thank you. So XEQT is the iShares Core Equity ETF, Mike?
Yep. And as the caller says, if you're just looking for long-term exposure to a portfolio that's going to have an all equity mix of a portfolio that's beyond just Canada, I think XEQT is great. We did talk a little bit about FEQT earlier as well. Also another good option, a little bit more spreading of the approach in FEQT in that it separates the portfolios into sort of 3 areas: quality, momentum, and value. And you have that across, Canadian markets, US markets, and international markets. So it gives you a slightly different tilt versus a market cap tilt. So they might work nice together. If the GIC is large and you could have both, that would be great. You pay a little bit more in the MER for that in FEQT at 43 basis points, whereas XEQT is 20 basis points. But that's a great one. It'll do exactly what the caller is asking for: a long-term patient money diversified across many equity markets.
Okay, that was Mike. Let's go on to Norm with his question. He's in Calgary. Norm, go ahead.
Good afternoon. I have a question about HMAX. You mentioned that briefly in responding to other question. So the way I understand this ETF is they give up a little bit of growth in the banks in exchange for basically insurance through covered calls. Yet I don't understand why it's ranked so low on Morningstar, and why does it fluctuate quite a bit? So if you could help us understand what causes funds like this to fluctuate down and pays really nice, healthy dividends. So it's a good thing to have a good part of it in the portfolio.
Thank you for the question. So this is the Hamilton Canadian Financials Yield Maximizer. Can you, Mike, just explain a little bit more how it works?
Yeah, well, in the Yield Maximizer, they are using covered call strategies to maximize income, and that's the key. So if you look at the Hamilton Canadian Financials Maximizer, and let's say you compare it to, it's not quite a fair comparison to compare it against the banks. So let me just do a slightly different comparison, more of a financials. So if we look at that, so you've got HMAX up about 36%, but XFN, which is a diversified financials ETF by iShares, that's returned 42% versus 36% for HMAX. So when you're maximizing the yield of a covered call portfolio, you're writing those calls at or in the money. So stock is at $10, rather than writing a call at $12 where I could be called away and having $2 of upside, you may be writing right at $10. You get a bigger premium for doing that, so the income looks larger. The challenging thing is that the portfolio changes a lot when you move away from the moment you write that call. So this is the moneyness of the call. How far out of the money is it? How far into the money is it? And the reason you're seeing some of the volatility to the downside, I'm assuming, that you're feeling, is that if we're always maximizing yield and writing that call right at that $10 level in my example, as soon as the stock goes up, we get less and less and less participation in the upside, and conversely, more participation in the downside. And so that's probably the volatility you're feeling, and that's the trade-off. If you're trying to maximize the income, how you're writing the calls changes, and that changes what the portfolio feels like, how much it goes up and down and participates on the downside and participates on the upside. So maximizing yield, remember, we're selling that upside in order to get that yield. The more we sell that closer to the price today, the more we have this funny thing that happens where all of a sudden it feels like we're getting more of the downside, not as much of the upside, and that's because we're receiving that upside in call premium and income. So it's a complicated topic, but as you look at those things, it's not always best to buy the ETF that has the highest yield. It depends on what you're looking for, what your investor preference is, and those types of things. So be very careful in that area.
Let's take a quick break, Michael. We'll get back to phone calls and emails in just a moment. Stay tuned. Welcome back to Market Call. Katie's on the line in Vancouver with a question today for Mike. Katie, go ahead.
Oh, hi. Thank you for taking my call. I would like to know if the Fidelity Canadian Growth Company Fund Series A, is that a good? Oh, Series A, is that a good ETF to buy for RRSP account?
Okay, thank you for the question.
Do you happen to have the ticker?
I think it's FID, Mike. Is that not what you're pulling up?
FID is no. That would be the International Dividend Aristocrats ETF. So it's a slightly different.
I think that's the one she
question.
was asking about, but I don't know if she just changed. That's what I have in my information. So let's talk about that one.
Okay, so the First Trust S&P International Dividend Aristocrats ETF is FID, and that's exposure to non-U.S. companies with strong histories of consistently growing their dividends. So that high quality factor in the international business segment. And so you get a tilt towards industrials, financials, utilities. We like all of that rather than the U.S. mega cap technology side of things. So that dovetails well in what we're talking about today. The nice thing is that you are prioritizing some dividends, and it is around a 4% yield. So that's nice. On the negative side, you don't get that dividend tax credit if it's outside of an RSP and things like that. But these types of strategies, that this focus on quality, tends to underperform on the upside, but also underperform on the downside. So much more sort of conservative approach. And I'll leave it there.
Okay, let's get to the next caller then. Renata's on the line. She's in Oakville, Ontario. Renata, go ahead.
Hi, good afternoon. I'd like your opinion on ZWB, as in Bob. I know nothing about it. I've held ZWE for a very long time, and I would appreciate your opinion on the ZWB. And I hang up and I listen to you. Thank you so much.
Thank you. So this is the Canadian Banks ETF, but it is a covered call. What do you think of this one, Mike?
As covered call writing goes, this is a fine ETF. As you say, it's the BMO covered call Canadian Banks ETF. MER's 71 basis point. Yield is about 5.6%. What I would highlight in this is that same sort of thing that we've talked about all day long with respect to covered calls and adding them to a portfolio. So ZWB, if we look at that over the last 12 months, it's up about 52%. ZEB, which is the equal weight BMO ETF that doesn't write covered calls, is up 63%.
Okay.
So it's up a full 11% more. And remember, we come back to this idea of when I'm creating the income by selling those calls and we're in a strong bull market, I'm giving away some of my upside in order to achieve that extra income. So you just have to think about that as you go through it. And remember, this is a concentrated portfolio of like 6 stocks. So, it can have runs in the 50+% range, but you are quite concentrated and quite focused in one subsector of a sector in the Canadian market.
Yeah, so it depends on how strongly you feel about the sector moving forward. Okay, let's get to our last caller today, Jim on the line in Cobourg, Ontario. Jim, go ahead.
I would like your take on the dimensional funds.
Okay. So Dimensional Funds, I think, is the firm. Mike, do you know it?
Yes, know it well. So Dimensional Funds, that advisor focuses on systematic, evidence-based investing rooted in academic research, largely out of the Chicago School of Business, and really does a great job of trying to harness the different factors that exist. For example, there's an investment factor for smaller companies. Why do smaller companies do better than larger companies? Why do cheaper valuations perform generally better? Why do higher profitability businesses tend to do better? And Dimensional thinks through these long-term edges and provides access to a myriad of funds that are all across that spectrum of harnessing the small cap premium, the value premium, high quality premium. And all these are factor-based investing strategies. Now, I will say also these factor-based investing strategies can underperform for long periods of time when we get into a market where you've got large cap domination by technology, which is what we've been in. But this is probably the class act of ETF and fund companies in the way of extracting those excess returns from these evidence-based, academically researched factors.
Interesting way of looking at it. All right, let's take a quick break. We're going to get to new picks from Mike when we come back. Join us tomorrow for Market Call. Greg Newman on the show with us. He is Senior Wealth Advisor and Portfolio Manager, Newman Group, Scotia McLeod. He'll take your questions tomorrow on North American equities. Let's get to some new top picks from Mike Philbrick. BMO's Equal Weight Utilities Index ETF, so ZUT, is where we start. What do you like about utilities down the line?
Well, AI is increasingly becoming a power story. That's what we've talked about all day today. AI equals electricity demand. The utilities are the second derivative of that AI trade, and we need grid modernization. And this is a defensive way to get some AI exposure. So you've got the equal weight structure diversified across those Canadian utility companies. And remember, the AI boom started with the semiconductors, hyperscalers, and software. The next phase is going to increasingly reward companies that are powering that infrastructure. And that's where utilities come in. this collides directly with the real world bottlenecks we've been talking about all along: power generation, grid reliability, and transmission infrastructure. And all those should lead to utilities doing well. They're becoming growth stocks, not the stodgy old defensive stocks that they used to be.
And I was going to ask you, because we've seen that run up over time, would you put new money in today? Are there pullbacks in this kind of ETF?
Yes, there will be pullbacks along the way, absolutely, as we go through the yin and yang of the geopolitical risk that is present. But you want to make sure you have positions in this. This is another way to think through AI exposure from a more conservative perspective as well. So if we have corrections, they'll probably be a little milder here than they would be in the general market, and certainly milder than they can be in the chip sector.
Let's get to your next pick then, which is the iShares MSCI Global Silver and Metals Miners ETF. So SLVP in New York. We talked a little bit about silver earlier in the show. Silver has had a run up, but tends to be more volatile. Who do you recommend look at this kind of ETF?
Well, again, it's about position sizing. If you're a conservative investor, you may just put a smaller amount in, 2 to 5%. And as long as the portfolio can handle and you can handle that volatility, you've got a diversifying asset. Remember, silver sits at the intersection of industrial demand and real asset scarcity. You've got the industrial side and you've got the monetary metal side. So solar, electronics, infrastructure, and inflation uncertainty. And we've seen it. We saw that huge run up in silver. We've seen the pullback. We're now seeing the digestion of that. And these companies that the ETF invests in are actually the companies involved in the silver extraction and mining. And so what you're benefiting from is the cash flows and the increase in the cash flows and the growth that these companies are experiencing, given the fact that silver is at much higher levels. But it is, as you say, best viewed as a satellite real asset allocation within a diversified portfolio, as the silver miners can be volatile. But that's up to the individual client and their preferences and risk tolerances to think through.
Let's get to the next pick, which is iShares, the S&P TSX Completion Index ETF. So XMD is what it is. And this is looking at sort of mid caps that are equivalent or parallel to some of the larger caps. Can you explain it a bit more? I'm not doing a good job of explaining it here.
Yeah, it's actually just exposure to the Canadian mid-cap equity market, right? Across the broad number of sectors: industrials, financials, consumer business, materials, domestic cyclicals. It's really the portfolio that completes the TSX 60. So you've got the 60 largest companies, but outside of that, there's another 100 or so companies that are quite large and growing, and they're in the midst of taking advantage of this industrial activity, the domestic growth we're seeing, and that capital spending. So if markets broaden out beyond the mega cap AI, mid caps are the ones that could finally start catching up, and they are. XMD is outperforming XIU, for example. So mid caps in Canada are performing very well. And it's very easy for a Canadian investor to look at this area and sector. It's in your currency. It's got this nice exposure to the Canadian economy and more of the resource side and the industrial side, building that in, not giving you any headaches around tax filings. The dividends are all Canadian corporations, so you get the dividend tax credit on those. So it's a nice way in Canada to really complete the portfolio and get away from the heavy concentration in that small group of U.S. mega caps, but also participating in what's coming with this AI wave.
We do have to leave it there, Mike. I appreciate you joining us. Thanks for your time.
Thanks for having me.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.